The HCL numbers at the bottom of your screen. You can see the PAT numbers 2,430 crores. The PAT number is looking higher. But if I look at the revenue, it seems that it's a decent big miss. So when you look at the revenues that have come in, the dollar revenue that's come in at 2.05 billion. That's a very muted number when you compare it, with the preview. If I look at the preview that we were going in with, the expectation was 207. 4, and they've just delivered 2055. So that's a pretty weak number. On top of that, the CC revenue has also come in at 2.7%. So again, that's a very weak number. Okay, we have Urmin Shah with us as well as Pankaj Sharma. Mr. Sharma, first reaction. Dollar revenue growth has come in at 2055 million versus expectation of 2075. Is that a big miss, or it's fine considering what some of the others have delivered?
It depends on which other companies we'll compare it with, but I would say that it's a decent miss because on a base where you are expecting at least a 1.5 to 2% kind of a number, and you have 0.8% in that sense, and also CC, which is 2.7%, is on the lower side. So I would call it a miss, and some of these guys had delivered like TCS delivered decent numbers. Also, the miss which we had in Wipro was also largely in line. So I would not put in the league of TCS. I would probably bracket it with Wipro. So that's a decent miss, I would say.
Pankaj, hang in with us. I'm going to now go across to Urmil for his first cut analysis of the numbers. What do you make of the numbers announced by HCL Tech, Urmil?
So the revenue, the US dollar revenue and the CC growth is in line with what we were expecting. We were penciling 2061 billion and the CC growth of 3%. It has come at 2.7%. However, the EBIT margin is a miss by about 30 odd bips. So I believe the miss is slightly on the EBIT margin front and not on the revenue front. And as expected, the CC growth outlook, the guidance for FY19, they have maintained. So overall, I would say the result is in line except the EBIT margin.
Right. So, Urmil, when you would look at the guidance, which is maintained the same, what does it tell you for the next quarters? This quarter, a significant part of the growth, about 210 bips, according to us, should have come because of the consolidation of C3I. What we are expecting next quarter is that the organic growth, in fact, comes at about 2 percentage points. So this is what we are expecting for the next quarter. Right. Sunita Nagpal is also now with us. Sunita, what do you make of the numbers? PAT is above. What's your sense on the revenue?
Well, the numbers are more or less in line with expectation. There's a slight upbeat as far as margin is concerned and the net profit is concerned. Top line is slightly tad below, and also you have to remember this quarter there was expectation that HCL Tech will pip Wipro, but they have been unable to do. They've fallen short by roughly about $100 million in this quarter. They'll need to do it probably next quarter to catch up across Wipro to become number 3 player in IT revenues. But the numbers are more or less in line with expectation, with marginal outperformance at EBIT level and the net level. For the top line, they have fallen short. As we were expecting the revenue growth of roughly about 3.1% in CC term, they have grown at 2.7%. So marginal disappointment on that front. Cross currency hit seems to be what we were expecting it to be. Guidance have been maintained at 9.5 to 11.5. EBIT margin guidance also maintained at 19.5 to 20.5. So more or less in line with expectations. But you will have to wait for the details how they perform in the segmental wise. Remember, IMS has been slightly sluggish. There is expectation is likely to pick up in coming quarters, or this quarter or the next quarter. It's expected to turn around. So we'll have to wait for those numbers. I'm still waiting those details. But the numbers at the moment seems to be more or less in line with expectations. Not much of a surprise in these numbers.
Right, ma'am. Just stand on with us. Pankaj, if we just look at the numbers, on the face of it, the CC revenues are 2.7% versus expectation of 3.1. So it's not that big a miss, or do you think that 0.4% miss on a quarter-on-quarter basis is decent when other companies are delivering good numbers?
Yeah, I would call it a decent miss, because when you see, let's say, on a YoY basis, the constant currency revenue growth is 8.5%. And you have a guidance which is saying that 9.5% to 11.5%. So on a full year basis, if you are expecting that this would be the growth which we would having, so 8.5% is a number which is lower than 9.5 even. So that is a cause of worry. And also when you see, I think another data point which you are seeing is that in terms of client addition, you have 100 million plus client net addition is one, and also 50 million plus 7 clients they have said that they have added. So which means that it's not a bad addition as such, but it's not terrific. It's not that great either. So I believe that in terms of either in terms of what you have delivered or what you're guiding for in terms of new client addition, I would not be very excited about these numbers as such.
Urmil, my question to you is that when we heard the management commentary from TCS, they sounded very optimistic. They sounded that they can do double-digit growth. HCL Tech, which has been bagging deals after and has been doing very well as far as IMS is concerned. Also, certain areas they had an early mover advantage. They were, of course, last year they outperformed the industry, but this year 9.5, there was an expectation that they might slightly do better than 9.5. Do you think there is a disappointment that they have not said anything or changed the guidance slightly or towards a upper band bias? Do you think there is a disappointment on that front?
So actually, we were expecting them to maintain the guidance, not up the guidance right now, because we need to understand that the IMS business has a very high weightage on HCL's overall revenue, and over there, the on-premise IMS solutions, those are facing headwinds because of the migration to the cloud. Even in this, if you see, the Mode 1 services have grown by just 0.5% in CC terms on a QOQ basis. Mode 2 and Mode 3, while they've grown at 8 and 12%, but still, they still need to become more share of the overall revenue to offset the kind of impact of the on-site or on-premise IMS solutions.
Another number that I want to point out is they've bagged 27 transformational deals in this quarter. That's quite a good number if you go by their track record. This is seems like a huge number of deal wins in this quarter.
So these, of course, would also include renewals that would have come, and while these deals would have a share of the Mode 2 and Mode 3 services, but it would have the shift from, say, in case of IMS, from on-premise to cloud. So the deal wins have been good for HCL in the past as well. Just that because of the transition, the growth on the quarterly basis has not been consistent.
Sure. Pankaj, my question to you is that although the growth or deal wins have been very strong, but the margins don't seem to be improving, and that's one factor that is not going in favor of HCL Tech. What do you think they need to do for the stock to move or outperform the market from here on?
Yeah, I think this has been a very, very important concern for quite some time. In fact, I would say that in last at least 2 to 3 years, some of these large deal announcements which have happened for HCL, there have always been a market concern that it has come at the cost of profitability in some of these contracts. And that is something which is playing out. And I expect that unless you try to find a sweet spot and a balance between how you want to grow and how profitable that growth would be, there is definitely a concern on HCL. So, of course, the market and investors need to see the growth, and revenue has to grow at least in line with the industry. But that has not been that much a concern because they have been growing pretty nicely. But profitability is a part where definitely more needs to be done. And probably I think it might require a bit more circumspect analysis and bit more understanding on management's part that they need to grow profitably. Profitability should be intact, and profitability should be at least getting better compared to historical standards.
Right. What do you make of the valuations, Pankaj, of HCL versus the sector? Do you think it will continue to trade at that discount?
Unless the profitability changes and unless market gets more excited about the sustainability of the growth rate, I don't expect that the valuation discount will disappear. So definitely it's a company which has last 3-4 years have been growing very, very nicely. But the valuation discount is more because of the concerns on profitability, as I was saying. And I don't, at least in this quarter, I don't get a sense that that concern is going away. So I expect valuation discount to continue at least for next quarter and even after 6 to 12 months.
Right, Mr. Sharma. Thank you so much. Urmil, always a pleasure talking to you.